Hello friends, welcome back. Today we are going to discuss about the whole financial world. We'll just take a brief note because we are not going to concentrate or go into more details about this. But we are just going to concentrate out of this whole financial world what is important for us. So I just want to take a small brief tour about the financial world, and then we will go through exactly what we are going to do about it, and where we are going to concentrate all our focus on. Okay, so going on to the next slide. This is a financial world slide. Now actually I have tried to summarize it in or try to arrange it properly. I could not find a better way to arrange it than what I did right now. So if you can see that there is a very cream color big circle which is like for the financial world. Now in this financial world you'll find that there are 5 different small worlds in that. So one is like and they are shown in the brown color. So first one is like say equity, second one is commodity, third one is say currency, and fourth one is like fixed deposit or banking system, saving bank account and things like that, and fifth market is derivatives. So financial market, it consists of these 5 broad small tools. Let's call it as tools, right? Now let's go one by one into that. Now let's start with the equity. Now equity, what happens is in equity we have like stocks and mutual funds. Stocks, the whole world knows, everybody knows about it. Everybody who knows about stock market knows about stocks. It's like we purchase some ownership of the company, just a bits and pieces here. We purchase a stock and then we get a dividend, and that's it. To purchase a stock, you need to do really little bit of investigation. We need to read some PE reports and balance sheet and things like that. So it's kind of like daunting task to do that. If you have knowledge and if you have really acumen for that, yes, you should work on in stocks. Next one is that if you want to invest in stock market but you don't have the expertise or you don't have time to go through a lot of stocks, a lot of companies and things like that, you can always go with the mutual funds. Mutual funds, they are like being managed by the fund manager who is a very talented guy. There is a lot of research goes into that, and they kind of purchase the stocks for you, and you just have to pay the NAV amount, that is net asset value figure, and you can purchase mutual funds. Okay, it's really very simple. You can just purchase the mutual funds and forget about it for years and years together. Nothing will happen. It will still continue to grow. And if you are very young and if you have not much knowledge about this, I really suggest that instead of investing your money or putting your money in the fixed deposits or things, you should really put some of your money or some of your investment in the stock market, actually in mutual funds. It will grow at a more faster rate than the bank. That much I can tell you. It's like history repeats itself. So you can just do a little bit investigation on Google or Money Control or any website where they tell more information about the mutual funds. So the equity is consists of this stock and mutual funds. So that's about it. Now in commodity market, what happens? Anything can be sold or purchased. Commodity meaning like cotton or corn or say silver, gold, iron ore, or anything that can be sold or purchased in a commodity market. And in the currency market, usually deals with the foreign currencies like USD versus JPY, or USD versus INR, or pound versus US dollars, or Singapore dollars, all those. So you can just take any currency pair and you can just start trading with that. And if you have knowledge for that, and just for your information, that the currency market, it is open 24/7, all 7 days a week, so it never closes. Like equity market and all other market, they close after certain time, so we have a day trade and things like that. But in currency market, it's like throughout market. So there are a lot of people who trade in this market, and so if you please help yourself if you want to do that. The last one is like fixed deposit and banking. So fixed deposit are supposed to be really very safe bet, and you don't need any knowledge about the market, you don't need any knowledge about finance to just put it in FD. Just put the money in FD and it will grow 5-10%, 10% around, I think so 7-8% nowadays the banks are giving. So you can just earn 7-8% of interest per annum, and just be happy about it. Now the biggest thing is about the derivatives. Now which is shown here as a big circle, derivatives. Now within derivatives we have two really very important segments. One is futures and one is options. Now in futures, these futures and options I have shown it in the more teal color. But we are not going to talk about the futures. So, and frankly speaking, I really don't know anything about futures. So I'm not going to talk about that. Now in options also we have another two small things. One is stock options and the other one is index options. What is stock options? Stock options means like Reliance or Tata Steel or whatever, all those companies, they also have their options, they also have their stocks. So that is called as stock options. And index like Nifty, Bank Nifty, IT, Nifty IT. So all these are the index options. So we are going to deal with only index options. Now if we go further down, in index option there are three main indexes. One is Nifty, that is the biggest Nifty index. Then there is a Bank Nifty, which consists of all the banks, and then there is IT Nifty, which consists of all the blue chip companies like Infosys, Satyam, and or not Satyam, I think so, Tech Mahindra now, and all other IT related companies. So, and then the Nifty. Nifty is the biggest thing, and we are going to deal only with Nifty. So the whole finance world I have shown. There are like different kind of tools, equity, commodity, currency, fixed deposit. Forget about that, we are not going to deal about it. Now coming back to derivatives, there are futures and options. We are not going to talk about futures, we are going to deal only with options. In options we have stock options, index options. We are not going to talk about stock options, we are going to only concentrate on index option. Index option, there are three small things: Bank Nifty, IT Nifty and Nifty. So we are not going to talk about Bank Nifty and IT Nifty, so forget about that. We are only going to concentrate on Nifty options. And in Nifty options also there are only few things that you really need to know, but you need to know that really in and out. Okay, so for Nifty we are going to do sell side. Most of the time, 90% of time, all our trades would be on the sell side. So you should be very much aware about what is put sell and call sell. You should know in and out about this. Then there are few times we are going to do buy side trades. One is so put buy and call buy, you need to know. We are going to discuss all these concepts in these basic videos, so don't worry about it. Just keep watching our videos and you will start learning that one by one. So and there are few more concepts that you need to learn about. What is margin, what is premium, and what is expiry, what is strike price, and all these kind of small things you need to learn. So your world that you really need to concentrate is really very concentrating on these few things that you should really know if you want to be an options trader. Okay, so now let's go through the presentation one by one. So here I am saying that in index options, like what is index option? Like we in the real life examples, if you have seen my past videos, in the real life example we have seen that I have taken the example for onion market. Now this options market is also very similar to that particular example, and actually again somebody might ask, like, what is option, what is it for or something. So there are only two things that is really, and I'm not going to quote any textbook definition of options. You can actually find it anywhere in the anywhere on internet, so don't worry. But from my understanding, the options, it is only used for only two things. One is hedging and the one is speculation. Now what is hedging and speculation? Hedging is like when you have like crores and crores of rupees in the market, you have invested in the market, and now you want to secure that oh, whatever happens if the market crash, I should be, my investment should not erode with the market crash. So I put a hedge on that. I put a hedging. So it's kind of insurance. So hedging is nothing but insurance. So we take an insurance, that is called as hedging. So option is used for hedging. That is one thing. Second thing, option is used for speculation. It's kind of a bet basically. It's a legal betting system, so don't worry about it. You are not doing anything illegal here. So it's a bet. You are speculating that something is going to happen in future, and based on your speculation, you are going to get some trade or not. So that is what is the speculation basically. So in this options market, what happens is like there are a lot of buyers, sellers, they keep on doing contract with each other. I'll do this, I'll do that, I'll do this, I'll do that, and that's the whole thing about the options market. So whenever an option contract is open, there are always two people involved in that. One is the buyer and the other one is seller. And at any given point of time, you can switch your roles either way. You can be a buyer, you can be a consumer. I know whatever I'm talking right now is going to be really very confusing for you right now, but don't worry about it. Over a period of time, and I have around, maybe I think so, in this series we are going to make more than 30 to 40 videos. So once you go through all those videos one by one, and I'm taking one very very small concept, trying to explain it, and you will learn about all these concepts. So don't worry about it. If anything that you hear today is going to be confusing, don't worry about it. It will become clear as you go by. Okay. Now in this we are going to concentrate only on the Nifty market, because there are a lot of reasons why we are choosing Nifty, and in next few slides we are going to discuss about that. So why only Nifty index, right? So it is also called as OPT IDX. Actually, in the technical terms, it's like, we can say it's a symbol for Nifty index, option index. It is OPT, that is for option, IDX stands for index. So Nifty OPT, OPT IDX. Okay. So actually derivative market, it is a secondary market, and based on the Nifty itself, Nifty. Okay. So the Nifty is just an indication that is happening, and based on that indication, we also saw this in the onion prices. Now in the onion prices also we did that. In the real life example, we saw that there is a market, that is the option market is going on there. There is one board which just says that what is the price of the onion right now, and there are traders here somewhere. They are talking about this and trying to guess about the onion prices, what it is going to be 3 days down the line, or 5 days down the line, or 10 days down the line. Even based on their understanding of the market, they are trading, right? So this is secondary market. Secondary market is the market where you are buying and selling the promises or the contracts. The actual market is different, so we don't worry about that. So in options, it is all here that the whole thing happens, right? So we'll be trading only in Nifty. Again, I'm saying it again and again, because that is what you should also keep in mind, and whenever I try to repeat it, it just means that it's really very important. Okay. Now the main thing why we are going to choose this Nifty is because it has a tremendous volume. Like at any given point of time, we have like 35 lakh contracts open or close, and with our 5 lakh rupees that we are going to come, I'm expecting, as I've explained in different videos, why 5 lakh and things like that. So watch those videos for more explanation about why 5 lakh. But what I'm trying to say is, like, when we are trading in market with our 5 lakhs, we are talking about only 5 lots. Whereas the whole options market, there are like crores and crores of contracts happening throughout India, throughout everywhere basically. Okay, so we are a very small guy in this whole sea of options. So this Nifty, there are maximum number of trades happening in Nifty. Bank Nifty and IT Nifty, not many people trade in that, so the volume is really very less. And why volume is important is because of the liquidity. I explained in one of the risks, one of the option risks, and I'm going to explain it in different videos. So this is one of the risks, that the liquidity has to be there. Okay, so because when you want to sell something, there should be a buyer on the other side. to purchase, or when you want to purchase something, there should be a seller on the other side, and Nifty has maximum buyers and sellers. So whenever you want to do something, there is always a chance that there is somebody waiting for you, basically. So that's why Nifty. Okay, Nifty is also called as Nifty 50, and actually Nifty 50, it's like a collection of index. It is just an index. It's calculation. It's a very technical calculations. Don't worry about it. But it actually comprises of 11 sectors like real estate sector, finance sector, bank, IT, and all these infrastructure sector. And top 3-4 companies are picked up and made. So this Nifty is like total 50 companies and their indexes and their value, basically. Okay, so and it is traded in National Stock Exchange. And if you go to the website, their website is www.nseindia.com, or now they have opened with the new website, that is beta.nseindia.com. So we are going to deal only in this again. So there is few more, just two more concepts that I want to talk. I have spoken about this in other videos as well, but since we are talking about the options and financial market, so we are going to just discuss few things. Now when we talk about stocks and the mutual funds, we are talking about something that is very real. Like when you pay the money and you get stocks or mutual funds in your demat account, and you can see that, and you can earn the dividends on the stocks and options. So this is a very real thing. Okay, so which means that if you spend around I've taken an example here. Say if you want to buy 100 stocks of Reliance, and if the stock price is trading at say 60 rupees, and if the lot size is say 1800 stocks, then in order to buy one lot of the stocks, which means around 1800 stocks, you are going to need 1,08,000 rupees. Now in this real physical thing, when you want to purchase or buy, you will need to have the whole 1,08,000 rupees to pay upfront, and then you are going to get that money in stocks in your account. You have to have full money, otherwise you won't be able to purchase, right? So this is really very important thing. And those stocks will sit in your demat account unless and until you decide to sell. So there is no urgency, there is no need to really panic when the market goes up or down or something. Oh, you have purchased, you know that it is a sound company, and everything is going to be okay. So you hold it for 2 years, 3 years, 5 years, 10 years, doesn't matter. So a lot of people have become rich this way. They have purchased the option stocks when they were really very small, when 200 rupees, and now they are trading at 3,000 rupees, 5,000 rupees or something. So I'm not saying that we are already late in the stock market. I have nothing to do with that. All I'm trying to say is that whenever you want to purchase a stock and the mutual fund, they are a real thing, and you actually have to pay the complete full money, and then you can get it in your account. It will stick in your account, and it will wait there until you decide to sell. So as simple as that. But in case of options, or stock options or index option, it doesn't matter. Let's talk only about option. In case of option, it's all virtual thing. Virtual thing means that you are not going to, when you say, okay, I want to buy one lot of say Reliance, as I took in the previous, and the lot size is 1800. So we are saying that we are not going to, when I buy one lot of Reliance option, I don't need the whole amount. I just need to pay the premium. Now in this example, in this sheet, I have taken that the premium is around say 3 rupees. Let's say premium is 3 rupees. So in these options, what happens is, if you want to buy one lot, you will have to pay only 3 rupees premium multiplied by 1800, that is the lot size. So you will have to purchase, you will get 5,400, you will need only 5,400 rupees to get one lot. Now see the difference. In the first case, in the physical thing, you needed 1,08,000 in order to get 1800 stocks. In options, you have to pay only 5,400, and you are going to get the same amount of stocks, but they are virtual. and it has a time limit. It has a time limit of say 1 month or until expiry. Okay. Now what happens? Now say market has gone up or down 10 points. Now if you sell this, you are going to get 10 rupees extra. 10 rupees multiplied by 1800, so you are going to get 18,000 rupees profit. Now in this also, if the market goes 10 rupees, the premium increases by 10 rupees, then you are going to get 18,000 rupees here. So which means that here you have got 10% increase in your portfolio, but here your portfolio is increased almost 3 times, because you only invested 5,400, you got one lot, that is 1800, and now you have made, if the movement is 10 rupees, you have made like 18,000 rupees. That is almost like 3.5 times or 3 times more money. So in options, the reason why options is very important and very famous and very liked tool by a lot of people is because you just need only partial of money and only certain period of time. You can have that 5,400 one lot only until expiry. After expiry, you don't have anything. It disappears from your demat account. So you cannot say, it's really a virtual thing. Until yesterday it was there, even though you didn't sell it or you just hold it in your demat account until expiry, it just vanished after expiry. It was just a virtual thing. But the best part is that you get to hold same amount of power. As if the market has gone up 10 points, you have the same amount of power as if you have purchased the amount, as if you have purchased the stocks, but here you are just purchasing it virtually. So there is a difference here. Okay, here you can keep it as long as you want in your demat account. Here there is an expiry date after which this virtual stocks, what you have, it will cease to exist in your demat account. So this is really a difference. If you understand this difference, like what is physical, what is virtual, and if you see all these videos, you will know what I'm talking about over a period of time. If you didn't understand what I just spoke, please reverse back this video and again go through that what I'm trying to explain, and please go to my website where you can also download this. Okay, so now we are going to discuss about what are different types of options. Okay, now in the world, we have like two type of options. One is American options and the other one is European options. Now in this figure I have shown that there is only very two different. I'm not going to go in really very detail about what is this American option, European options. You can find it on the internet, but I'm just going to explain one very small concept here. Now if you see the left hand side graph here, there is a market movement and the time is there. And in case of American type of options, what happens is that as soon as the market hits your strike price, I have shown it in the pink color point or the dot. Now at this point what has happened is your stock price has gone above the strike price. Now in this situation what happens is the American options will get expire. You will be, technically it will expire, and you will be that contract will get executed and you are going to lose or gain money or whatever, right? This happens in the American kind of options. Now in European kind of option, what happens is no matter what happens, the contract will be kept open until expiry. Now you see on the right hand side there is one green line. Now that green line is something that is not appearing in the left side graph, because our contract in the American options got executed immediately as soon as the strike price was hit. Now in the European side it went up and again it went down, and then only at expiry, that is the blue dotted dash dot line I have drawn there. So you'll see that only at that expiry, at that red dot, the contract ceased to exist, right? So the only difference is that in American type of contracts, the contract gets executed as soon as the terms are met, as soon as the conditions are met. It doesn't wait until the expiry. Now in case of European options, it waits until expiry or until somebody closes the contract or opens the contract, or something like. If you purposely close the contract, then of course it will get closed, but it will by default it will wait until the expiry to expire. Okay, now as a joke, because we were ruled by Britishers and they are from Europe, so we are using the European options. In at least the index option is European options. I don't know about the stock options in India. I heard it was, I mean, they are following the American options or something, but I don't really care about what they do, because I only care about index options, and they are European. So don't worry about it. There is nothing to doubt about it, that it's European type, and every contract it will wait until the expiry, even if your strike price is hit. Doesn't matter, don't worry about it. Now what are the different parameters? Like when we open the options, there are only 7 very important things that you need to remember. First one is, what is contract? Contract, it is just a promise that you make. If you are a seller, you make it with the buyer, or if you are a buyer, you make it with the seller. So it's just, contract is nothing but a promise that you are making certain things, you are agreeing on certain things, something like that. And this, once you do the contract, it's really very binding. You cannot say, oh sorry, I made by mistake or something. No, you have to close it, and whatever loss profit you'll have to take it, and then you'll have to move on. It's a very binding contract by law. Okay. Second thing is contract type. So there are only 4 contract types that you can open in options. So it is call sell, put sell, call buy, put buy. There are only 4 things. So there are only, really, if you look at the whole options world, there are only these 4 small concepts that you really need to master in and out. Once you master these 4 concepts, like the whole battle you will win, and suddenly everything will start making sense to you. But you have to study about these 4 concepts in and out. There is no shortcuts in this, otherwise you are going to lose money. Take my word about it, right? So even if like you are in your deepest sleep, and if somebody calls you and tells you, oh, what should I do, I am in this situation, you should be able to tell him, do this or do that, based on your knowledge about call sell, put sell, call buy, put buy. Okay, so that is the contract time. Expiry date. So whenever you make a contract, there is always an expiry date, until when you want certain things to happen or not happen. So that is the expiry date. We'll go into more details about this throughout this whole 50 lecture series. So this expiry date is not going to be really anything surprising that you are going to listen to only one time from my mouth or something. So you'll listen about this all the time. So strike price. Now premium is what you have to pay, or you get. Say for example, if you are a call sell, or if you open call sell type of contract or put sell type of contract, then whatever is the premium that you are going to get, so the seller gets the premium. If you are doing call buy, put buy, you are going to pay the premium. So premium is what is the token. I have explained in my real life videos what is that token and what it is. If you don't know what I'm talking about right now, about what real life examples, go back to my videos. There are some videos I have made. In those videos I have explained what is premium and things like that. So for the time being, just remember that there is premium, and then there is a margin. What is margin? Margin, we are going to, there is a separate video for the whole margin thing. It's really very important. So margin is like whenever you do call sell or put sell kind of contracts, they are supposed to be really very risky contracts. So your broker needs you to keep a margin with them. Okay, that margin, like for one lot right now, the margin is somewhere around 90 lakhs. So when I say that we are a retail investor and we are coming in the market with 5 lakh rupees of investment, which means that we are going to be able to, when we keep this 5 lakh in the margin account, maximum lots we can buy is 5, because 90,000 multiplied by 5 is 4,50,000. So maximum you can buy maybe 5 lots, and you need to keep some 50-60,000 as a buffer. Just in case if the volatility increases, the margin also increases. Margin increases by day basically, right? Based on the market condition. The margin increases or decreases. So Margin is important, and lots, basically how many lots you are going to trade. So whenever you do a contract with somebody, these are the few things. First thing is which type of contract you want to do: call sell, put sell, call buy, put buy. Either of these four you will do contract, right? Then which expiry date, what should be your strike price, how much premium you are going to get, how much margin you are going to need, and how many lots you want to purchase. So only these few concepts are important in these options, which we are going to learn. So this is all about the financial world. So keep watching all these videos. I hope they are very informative and you are learning something. If you are not able to understand anything, you can always put the comments in my video and you can ask me, or you can visit my website www.TheIndianOptions.com, and you can also subscribe these videos. And thank you very much for watching my videos. I really appreciate you spending time on this. And if you have any questions, again, please don't hesitate to reach me out. Thank you very much for watching this video. See you again in the next video. Thanks. Bye.